30th, President Trump said he'll slap a 5% tariff on all Mexican imports starting June 10th unless Mexico moves to stop the flow of people illegally entering the United States from the Mexican border. And he said he'll increase those tariffs by 25% on October 1st if he doesn't feel the Mexican government has done enough. This is impacting investors. For this move, President Trump is facing criticism from both the Democrats and Republicans. Keep in mind that this announcement came 2 weeks after he reached a trade deal with Mexico and Canada called the USCMA. And now it looks like Congress will be more reluctant to approve that agreement. This last move with Mexico was something that nobody expected, and the market really doesn't like surprises. It can lead to a feeling that things can change on a dime. And that makes it risky for business to make long-term investments. And that in turn leads to lower earnings and potentially lower equity prices. That's why the market reacted negatively to this news. Now, no one knows if these Mexican tariffs will be put in place, and if so, for how long. But of course, that isn't the only trade war the United States is involved in. We also have China to talk about. And on that front, the rhetoric and restrictions are picking up steam. If the Chinese-American trade war intensifies, it could lead to a big hit, especially to retail stores in our economy. Some economists predict that if things get really bad, up to 12,000 stores could close. And we could also see technology transfer bans with the United States banning sales of certain equipment, machines, and know-how to China if we fear that they were illegally stealing it. Now, if that happens, it could lead to a break in the global supply chain and potentially push the world closer to a global economic slowdown. Now, nothing's inevitable. There are all kinds of scenarios with China. The U.S. economy has a lot of momentum, and it won't feel much of a hit from the recent increases from 10% to 25% tariffs on the $200 billion of Chinese imports, according to the DWS chief investment officer. According to that person, there's a 75% chance the situation will de-escalate or remain the same, and if that occurs, it probably won't impact the market that much. But according to that same analyst, there's a 25% chance that Trump will expand the tariffs as promised on an additional $300 billion of Chinese imports. And if that happens, there's a small chance it could lead to a global recession, although experts think that this result is highly unlikely. Now, I don't know what's going to happen as a result of tariffs with China or Mexico, but just for a minute, let's consider what happened in the past when tariffs were enacted. In 1984, President Reagan went all out on trade tariffs and restrictions. That included restraining Japanese auto imports and forcing Japanese to buy American-made parts. He put quotas on imported sugar. He required 18 countries to restrain from selling steel to the United States. And those countries included Brazil, Spain, South Korea, Japan, Mexico, and the EU. He slapped a 45% tariff on Japanese motorcycles. He forced Japan to control the price of computer chips. And the list goes on and on. He even put quotas on imported clothespins. Now, all this hurt consumers, but not so much investors. Take a look at this chart. You can see that from 1984 through 87, the market did pretty well. President Obama was also no stranger to trade tariffs. In 2012, he slapped tariffs on Chinese solar panels, steel, and tires. Yet again, the market did pretty well. Even if you look at the Great Depression and do some research, you'll discover that tariffs put in place by President Hoover at the time didn't cause or exacerbate the economic situation at the time. At least that's the conclusion I came to by reading what economists such as Milton Friedman, among many others, said. Bottom line, the economy is strong right now. It is slowing, but it's strong. You can see that by reviewing charts on spending, which is still strong, and inflation, which is still very low. The existing trade disputes may slow things down further if the Chinese tariffs are expanded. That could slow the economy and hurt the market. In the past, tariffs haven't really been the death blow to the economy. It's not a guarantee of the future, but it historically has been the case, and it's worthwhile remembering. But it's also important to note that we are investors, and as such, at some point, the market will change directions. The economy will go into a recession, and we won't make profits every year. But in my experience, it's riskier and more expensive to try to time those things. And it's better to make sure you have the right portfolio mix to help you achieve your long-term goals and take the right amount of risk and ride through the ups and downs. Of course, it's important to accept that sometimes any portfolio approach will lose money. Now, if you'd like to discuss your portfolio or any other financial issue, just call Kim in the office to set up a meeting. She can be reached at 818-889-6700. I look forward to connecting with you. Thank you.